Welcome back to the European Market Open. 12 minutes
Good
since we're
morning,
trading
everybody. I'm placing an order to sell short the Japanese yen at 107.299.
Through the night it took once again, but stocks in Europe up by 0.9%.
Order placed to sell
it's
short
politics, but it's also the
Japanese yen at 107.299.
Market strategist is still with us. And Willem, we had numbers from Novartis, and that made me look for details of the healthcare sector in your notes. And you talk about health tech, and what is
will want to spend much more on healthcare. Governments will want to spend more on it as well. So it is a structural growth sector, and actually something that has a lot of interest from a lot of our clients who are looking for areas to either directly invest through private
Position open and Japanese yen at 107.300. Okay, I opened new position. It's short position at 107.300.
Of all of the smart technology to give those advantages to provide people with better health at a cheaper cost. So in the West, it's more about providing it at a cheaper cost. In emerging markets, it's more about giving people access to healthcare through technology.
You also like cyclical stocks. I wonder what you think. I always wonder about the automakers, and really especially in light of the hit that they took during COVID, the fact that so many consumers may be out of a job when it comes time to, get out of your house and buy a new car, and the fact that automakers have to invest so much in electric powertrains. All of these things seem to make investing in automakers a difficult prospect.
Correct. So we're, to be clear, we're not overweight on cyclicals. We have a neutral cyclical stance on cyclicality. So with that overweight on some cyclicals and on some defensives. I think you're right about the automotive sector, which has the real challenges of having the self-driving cars together with the investment in green technology as well. And it's only really those companies that have the strong balance sheet, the strong brands, etc., that are going to be able to position themselves well for the future. This is actually a theme which runs through the different sectors in our whole investment strategy, is that we continue to stick to quality. We're not going down into the jungle, in the poorer quality companies, because it's not just around survival in these months as we transition this crisis. It's also the ability to invest for the future, where you have to have that strong balance sheet. It's also about being able to maintain your margins, because we're starting to see some margin pressure, either be it from taxes, from the deglobalization, or actually from cost pressures that you're starting to see, even labor market cost pressures, where there is going to be an element of fairness and social security contributions. So it's only those companies with the strong brands that are going to be able to charge that through that cost increase, because clearly there is from a demand perspective, if demand is weak, we're not going to see a lot of CPI inflation. So many companies are going to have that margin. So stick to the quality companies.
Willem, I wanted to ask you about supply chains, because you talk about automation as being one of your themes that you invest around. A recent HSBC, it was in fact, a survey of customers in 14 nations talked about actually how the majority of those clients, they don't want to reshore all their supply chain. They just want to exert more control over it. They want to maybe diversify some of their suppliers to different geographies. How is that kind of trend informing your investment strategy?
Yeah, so we like automation, and one of the reasons is indeed the supply chain movement, where somebody labeled it as moving from a just-in-time into a just-in-case situation, where companies are looking at we've gone through trade tensions, we've now gone through COVID, both shocks to the supply chain. Now you're not going to be able to repatriate everything, to re-onshore everything. We already saw that last year when there were the first signs during the trade tensions of Chinese companies looking at, can I start to produce somewhere else? Well, the problem obviously is that if your suppliers or your customers are sitting next to you in clusters in China, you're not able to rip out that company and just put it somewhere else. Also, obviously, you have to have the expertise and the labor market, but labor market skills. But still, we think they are going to diversify their supply chain to some other countries and also some partial re-onshoring. That is going to lead to a lot of automation to make that supply chain safer for the customer, but also for the worker, and also more secure and more certain.
Willem, thanks so much for your time this morning. Willem Sells, HSBC Private Bank Chief Market Strategist. Willem will be continuing his conversation with us on Bloomberg Radio. Matt and I head there at 9 o'clock UK time, 10 o'clock if you're in Berlin. Coming up is the worst over for UBS. The bank has signalled a return possibly to buybacks. What about dividends? We'll bring you our interview with the CEO, Sergio Ermotti, next. This is Bloomberg.
Our basis scenario, the 70%, is de facto based on severe economic contractions in the next few quarters and with a recovery, although not to the same extent that we will see the slowdown in 2021 and then coming into 2022. The 30% is of severe recession, and this is really the one that we need to put in our models in order to have the prudence necessary.
Look, in the past 24 hours, vaccine and volatility, they've combined, haven't they? The narrative has shifted. Could a vaccine deliver the kind of alpha for markets in the second half that the dislocation that we've seen in the first half. Could this vaccine really change the V narrative?
No, the vaccine probably could give a better hope, in my point of view, at least for the midterm, not the short term. The short term, yeah, maybe there is a little bit of rebound, but a lot is priced. A vaccine would not be impactful in the next 12 months in any case. So I do think that the reality is that what we will experience after this crisis is that many companies will be able to make it and go through and be probably even stronger or be well positioned for the future. And the one that were already struggling before the crisis probably will have a hard time to recover. And this is where you will see probably still a second leg of the economic consequences of the crisis being played out.
With that scenario, are we underpricing, underassuming the level of defaults that will come globally?
Well, it remains to be seen, but it is fair to say that markets remains quite complacent, I would say. That there is not a lot of, if you look at equity markets, even credit, which were quite a good investment pick, as we spoke last time.
You did make that call, to be fair.
Well, now they are, if you look at spreads have been coming and therefore there is not a lot of room for many negative surprises going forward.
JP Morgan says that as far as the credit markets are concerned, we are in a hallucinogenic moment. We're locked in a collective hallucination in credit markets. Does that chime for you in Europe and the US, Sergio?
Well, that's, it's not very surprising if you see across all asset classes, the amount of liquidity and money around is driving this kind of situation. So one has to really continue to look at a huge diversification and not avoiding concentration on any kind of asset class or underlying.
You still think there's mileage in credit, though, even at this stage with the central bank backstop?
Where in some areas maybe there are opportunities to pick up, but as I said before, the name of the game is diversification and also taking a little bit maybe liquidity risk on certain kind of investments in return of higher long-term returns.
And that was the CEO of UBS, Sergio Armati, speaking to our own Manus Cranny. Manus joins us now. He's in Zurich on tour, speaking to the biggest CEOs in Switzerland. Manus, great interview there. Buybacks, the dividend, they seem to be the main drivers this morning. How important are they to the UBS narrative?
It's what sets UBS really, I think, apart from many of the others. Yes, all the regulators around the world held back from bank dividends. If UBS can get back to paying the tail end of 2019 and begin the conversation again about buybacks, the language that Armati used during the interview was a possibility but not a commitment. This is to share buybacks in the fourth quarter. Now, everything's got to go pretty much according to plan to deliver these kind of aspirations. You can ask yourself, their credit losses, $272 million, yet the US banks put aside $35 billion. Even if the UBS model used the US accounting system, you're looking at losses of around $672 million. So a lot has got to go right, Matt, Anna, to get this dividend and buyback in place.
Manus, just very briefly, what about the trading side of things?
A cracking set of number of FICC. This isn't an investment bank. I just want to remind everybody, this is one of the biggest wealth managers in the world, but FICC up 118%. You may say, barnstorming, yes, it is in that context, but it's nowhere near what you saw, from example, in Morgan Stanley, 167%, Goldman Sachs, 148%, but it is still a cracking number, and the wealth management beat comfortably. So a pivotal moment will come around the elections. 61% of their clients will change their portfolios. There's a wealth management moment coming, and it comes at the election. Anna, Matt, good morning.
Manus, thanks very much. Bloomberg's Manus Cranny live on the ground in Zurich. It's just like old times, isn't it? Manus on tour, talking to all of those key Swiss leaders. More from him later on this week. This is Bloomberg.
Welcome back to Bloomberg Markets. This is the European Open, 30 minutes into the trading day right now, and we're looking at gains across European equity indexes. Let's take a look at the benchmark stock 600 right now. You can see it was up and away at the open, and it has remained over the last hour at gains of around 1%. If you take a look at the GRR screen on the stock 600, you can see in terms of the group ranked returns, the industry groups that are moving, all of them up, but the biggest gainers are the cyclicals and the bank stocks. So auto and auto parts makers, as well as bank stocks leading this rally. Tech and financial services not far behind, but of course everything is gaining, with telecoms the only industry group that really isn't making much headway. Let's get the Bloomberg First Word news right now. Here are today's top stories from the Bloomberg terminal. EU leaders have reached a landmark deal on 750 billion euros of stimulus. It will see the bloc issue joint debt to help member states tackle the economic downturn. The package includes 390 billion euros of grants and 360 billion of low-interest loans, and the agreement comes after more than 4 days of negotiations. It required unanimous approval, and it took a little bit of watering down and a lot of rebates to get that done. Some British lawmakers are looking for the UK to take an even harder line on China, and they'll use a visit by U.S. Secretary of State Mike Pompeo to put pressure on Prime Minister Boris Johnson. Sources tell us the MPs want Johnson to impose sanctions on Chinese officials over human rights abuses. One MP is calling for a strategic overhaul of the UK's relationship with China. Jeff Bezos added $13 billion to his already high net worth yesterday. That's the biggest single-day jump for any individual since the Bloomberg Billionaires Index was created back in 2012. Bezos' wealth is up more than $74 billion this year alone. That would make him, that increase alone would make him the 7th richest person in the world, if he weren't already the #1 richest person in the world. Jeff Bezos, I guess it's fair to say he has a high net worth when he has the most money of anyone in history, almost $200 billion in total. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. Anna?
Yeah, that's a lot of parcels, isn't it? Let's talk about tech. Tech has long been the poster child for growth, but steady earnings growth and an ability to make money in the stay-at-home world has made the biggest tech names synonymous with quality and utility too, perhaps. As the industry's earnings get underway, Scarlett Fu goes in search of potential problems.
The biggest knock against big tech, their outsized gains leave little room for misses, and investors who've been piling in may be quick to flee, especially if vaccine optimism or an improving economy sparks a lasting rotation into other sectors. So here's what could remove some of the shine from the 5 biggest tech names. For Apple, the pandemic may delay the iPhone 12 and leave the company unwilling to give a sales forecast for this quarter. Amazon revenue likely grew more than 25%, but it's also spending a lot. How much will it spend to keep its delivery network running smoothly and on COVID-19 expenses? Microsoft is benefiting from a shift to the cloud, but is it giving up some revenue now by allowing deferred payments on some contracts? And if the economy stumbles further, advertising budgets could disappear, hurting Facebook and Alphabet. Alphabet tends to rely on small businesses, particularly in the hard-hit travel sector. When you've only gone up, it doesn't take a lot to knock you down a peg.
And that was Bloomberg's Scarlett Fu looking at tech surge as the industry's earnings reports get underway. Joining us now is Nicholas Janvier, Columbia Threadneedle Investments U.S. Equities Portfolio Manager, to talk a little bit about, well, first off, let's talk about tech. Nick, I mean, the gains have been incredible. Anna was pointing out this morning that I think the top 4 tech companies are worth more than the entire Japanese market. Can it go any higher from here?
Good morning, Matt and Anna. Thank you for having me on. Well, look, I think it certainly can go higher from here because at least what we've seen thus far is the great lockdown has really cemented the dominance of these mega cap growth companies. And when you're looking at the S&P 500, the index is obviously very, very top heavy with these types of companies. But certainly for me, as someone who focuses much more on the mid and small cap Russell 2000s, it's a little bit not to have a little bit of large cap envy because, of course, the Russell 2000 is not quite as populated with these type of business models.
Yeah, let me ask you about that distinction then, Nicholas, between the big caps and the small caps in this space, because I was looking at this chart around momentum in the NASDAQ, and it's at the highest in some 20 years. And so then you ask whether this is going to continue to be the story for the large caps or whether it's going to be companies away from the NASDAQ that do well next. Where are you looking then for the next leg of tech gains?
Yeah, sure. One of the things that we've seen thus far, there's been a lot of focus on this value versus growth, underperformance or outperformance, depending on which side of the table that you're sitting on. One of the things that is a derivative of that has been massive outperformance of large versus small. If you think about the S&P 500 versus the Russell 2000. Of course, the challenge with the Russell is that the Russell is more domestic, more cyclical, and more consumer-oriented. But it's not to say that there are not businesses in the Russell 2000 who are also benefiting from the stay-at-home economy. Probably the most direct play would be for one to be looking at the suppliers of these mega-cap growth companies, because those are the type of businesses that you're going to find in the Russell 2000.
Are you concerned at all about the wave of bankruptcies that everybody's been warning about? A lot of people saying that the third and fourth quarter are going to be worse. The second half is going to be worse than it was in the second quarter. Is that going to hit the smaller companies and then cause pain all the way up the chain?
We have for a long time been very focused in sharpening our pencil on what's going on with the balance sheet of the companies that we're invested in. So from an index perspective, I do think that you are, if this lockdown continues to go on as is, you are going to start to see some real pain as far as this business models are concerned. Certainly the more highly levered business models that are part of the Russell 2000. For us, one of the things that's really important from the perspective of an active manager, of course, is to avoid those businesses that are secularly challenged and heavily leveraged. So when you look at our portfolio, you're not going to find any of those names represented in our holdings.
What difference will the election make, Nicholas, as we head towards it in terms of this, the allocations to different parts of the tech universe? What bearing will the election have on that?
Well, historically, markets will certainly start to focus on the election as we get closer to the Labor Day holiday in the U.S., which is about 4 to 5 weeks away from today. One of the really important things that an investor is going to have to do here is to be able to distinguish between noise, which is going to cause a lot of short-term volatility, and information, which potentially is going to have some longer-term impact on industries and business models. Specifically to tech, I would say that they're facing the same issues that a lot of the companies in the market are going to be facing, and that's the potential that the tax rates, the corporate tax rates, may start to move back up from here. When you've looked at some of the policy proposals that Vice President Biden has put forth, if you do have a change in administration, he's been very clear that they would be looking to roll back some of the tax cuts that were enacted in 2017. So the expectation is not going to be that the tax rate is going to go back to the previous 35% at the statutory level, but something in the mid-20s certainly seems likely to us. So I think it's important for an investor to be focusing on where are your companies today as far as what their actual tax rates are, how much of their earnings are they sourcing from overseas versus the domestic market, and all of those things are going to play a big part in what their effective tax rate ends up being from here.
What do you think about the prospects for the dollar, Nicholas, and how does that affect investments from the U.S. point of view? I mean, do you see it weakening, and is that just fantastic news for the tech companies that are going to be collecting in foreign currencies?
Yeah, you know, I try not to be overly focused on the dollar because, of course, that's thinking about things from a very high level macro perspective. But I can tell you this. Generally speaking, it is well understood that a weaker dollar is good for companies that source a lot of their incomes from overseas. So to the extent that the dollar does weaken from here, there are clear and obvious advantages to companies that have a lot of overseas exposure. One of the things that is not talked about a lot is a weakening dollar also has a lot of benefit from smaller companies. From the perspective of it allows them to source their raw materials at lower prices, right? So from the perspective of a small and mid-cap investor, I'm much less focused on the impact of the dollar from a top-line perspective and much more focused on the potential benefits that come from that to the cost structure of these companies.
Okay, yeah, really interesting with that global supply chain. Nicholas, thanks very much for joining us. Nicholas Janvier, Columbia Threadneedle Investments, U.S. equities portfolio manager, talking about the big and the small caps when it comes to technology in particular. Up next, we'll talk about Europe and the politics. Europe united. The region's leaders agree an unprecedented stimulus package to pull their economies out of recession together. We're live in Brussels for more detail. This is Bloomberg.
Welcome back to Bloomberg Markets. This is the European Open, 45 minutes into the trading day, and looking at gains across the European equity indexes, the DAX rising almost 1.5%. Let's get the Bloomberg Business Flash right now. For that, we go to Laura Wright in London. Laura?
Thanks, Matt. UBS is signaling it may resume share buybacks and dividend payments as soon as next quarter. That's after reporting higher than expected net new money at its wealth management business. But Chief Executive Sergio Amotti says a buyback in the fourth quarter is a possibility, not a commitment.
Of course, the situation out there is still very challenging and very difficult to predict. So we should never be complacent. It's a strong first half, but we are also very focused on managing the second half of the year, but also with a level of confidence that should the situation be continue to be somehow benign in respect of our business, we should not rule out at this stage, some degree of share buyback.
Danske Bank may need to cut at least 1,000 jobs if it's to meet the latest cost-cutting goals. That's according to analysts monitoring the lender. The bank's chief executive told Bloomberg on Friday he's planning significant staff cuts. The lender isn't commenting beyond the guidance it gave last week. That's your Bloomberg Business Flash. Matt, Anna.
Laura, thanks very much. Laura Wright in London with the Business Flash. Back to developments in Brussels overnight. After 4 days and nights of tough talks, European leaders have agreed on a landmark stimulus package that will see the bloc issue 750 billion euros of joint debt. The emergency fund will give out 360 billion euros of low-interest loans and 390 billion euros of grants. That's less than the 500 billion euros in grants that the French president and the German chancellor had included in the earlier draft of the proposal. But the deal represents a victory for a collective EU response to the crisis. Joining us now from Brussels is our reporter Maria Tadeo. Maria, that's the positive story, that's the Europe United story, that's the didn't we do well, we reached an agreement story, and clearly it's been a hard journey to get there after all these days and nights of talking. Now we've had some time to look at some of the details, though. When is some of this money actually going to get to the places that need it?
Yes, Anna. So now we do have more detail. We know the overall package is 750 billion euros. 390 will be handed out in grants to countries badly hit. That is confirmation of the figure that we reported yesterday. But if you look at the breakdown now, we're looking at 82 billion euros for Italy and 72 billion euros for Spain. Now, there will be a lag in the payment. This doesn't mean that the money is going to come tomorrow. We're looking at that money being front-loaded between 2021, 2022. Having said that, when you speak to officials from the periphery, they say that this is not necessarily a bad thing, that the European Central Bank has provided a lot of relief for this year, and the governments really need time to figure out how they're going to spend the money and to be able to really absorb the windfall that they're about to get. So yes, it's not an immediate solution, but there is relief here that a country like Italy or Spain are really about to get a lot of money that they're not going to have to take on as debt, and that was their major concern here. They did not want to see their debt to GDP ratio increase as a result of this. When you look specifically to the case of Italy, it's also interesting, Giuseppe Conte this morning pretty much ruling out that he's going to want to tap into the ESM given the compromise that we had this morning.
So the question I think now, Maria, is that enough? I mean, we've seen trillions go into the U.S., and they're talking about trillions more. Of course, it's a much bigger economy with a lot more people. But, you've seen as much as the entire European rescue package go into Germany alone. Are these, double-digit numbers in billions going to be enough to save economies like Spain and especially Italy with more than 100% debt to GDP already?
Yes, Matt, and you make actually a very good point, and there is a very clear sense, and this is, again, going back to the point of the frugals that really insisted the money has to be used well, and we really need to see major reforms. There is a sense here that this, of course, is good news for the periphery. Just a few weeks ago, we talked about the ESM. It seemed that this was going to be your typical bailout. Now these countries are getting a windfall, but this is not going to be enough. We're going to see, or we're going to have to need reforms in countries like Spain and Italy, a real growth plan plan to kickstart those economies. And of course, the question mark as to what exactly is going to happen with the health situation. We don't know whether or not we're going to see a second round of the virus, and we don't know how quickly both economies can go back to normal. So yes, you could argue it's good news that this money is coming through, but this is just a short part of the story. There's a much bigger issue here, and when you look at Italy, you're looking at, well, structural problems that have been an issue for decades now, such as the low productivity and those problems that are really becoming structural in the country.
Maria, thanks very much. Maria Tadeo on the ground for us in Brussels, enduring that 4-day summit for us, bringing us all the detail. Let's get back to some corporate news flow. We've seen some M&A news that is certainly moving the markets. eBay, as we told you earlier, agreed to sell its online classifieds business to Norway's Adevinta. We see Adevinta is up by 30% right now. We don't always see acquirers making gains to that extent. They managed to beat off Prosus, of course, owned by Naspers. They also managed to beat off private equity competition to get their hands on this asset. This is Norway's biggest deal in more than a decade. So quite a significant story for Adevinta, which operates some other marketplaces in Europe and in Latin America. It was actually spun out of Schibsted last year. Up next, we will continue the conversation around the EU landmark deal and break down the market reaction for you. We'll be joined by Christine Aquino, who leads our Markets Live team here in Europe. This is Bloomberg.
Welcome back to the European Open. We are almost an hour into the session and looking at gains of more than 1% on the CAC 1.5% on the DAX. Joining us now to talk about this rally, Christine Aquino, who leads our MLive coverage in Europe. And Christine, it really does look like this is the EU package, the EU rescue fund that's driving these gains, even though it may have been expected. Markets seem bullish on the completion. Is that the case?
Absolutely. Absolutely, Matt. I think, the announcement in mid-May was one thing, and the fact that it was even on the table was definitely a watershed moment in a lot of ways for Europe. But the fact that there was a concrete deal, and it came as soon as now, as we know from the history of European politics, that's not exactly the case when we were looking at previous spending deals such as this, and it involves all the EU members agreeing on a single thing unanimously. That really is quite a feat for the region. And it's even surprising to us over in Markets Live, the fact that there was still this capacity for a rally on the actual announcement today, as we've seen in examples similar to this in the past. There's been a tendency for investors to buy the rumor and sell the fact, but we're not seeing much of that today.
Yeah, not seeing it, and in particular on Italian assets then, Christine. So we see in the bond market and also in equity markets where the FTSE MIB is up by more than 2%, really outstripping some of the gains we're seeing elsewhere.
Absolutely, Anna, and that just goes to show how much Italy has at stake in terms of benefiting from this program, given that Italy is, of course, one of the countries in the euro area that has been hard hit by the virus, and the economic impact of that is really going to be long-lasting beyond this year and the next couple of years. And so it's really a testament to how much Italy has to gain from this package, the fact that both its bond markets and its equity markets are rallying. Notably, of course, the 10-year Italy bond spread has nearly erased its post-pandemic widening. That's back down towards 150 basis points versus German bonds, and back to levels before the pandemic really took a hit in Europe in late February.
All right, Christine, thanks very much for joining us. Christine Aquino leads our MLive team here in Europe. For her work and the work of her colleagues, just type MLIV GO on your Bloomberg terminal. That's it for the European Open. Stay with Bloomberg Television. Up next, it's surveillance. On the other hand, you can also switch to Bloomberg Radio. Anna and I are headed over there to continue our conversation with Willem Sells from HSBC. If you're in the London area with this beautiful view of St. Paul's, just switch over on DAB Digital Radio to Bloomberg.
New order placed to sell short Canadian dollar at 135.061. So order placed to sell short at 135.061. New position open at Canadian dollar. Short position at 1.35061.
Deal done. EU leaders agree a 750 billion euro coronavirus recovery package after more than 4 days of tense negotiations. The worst may be over. UBS signals the peak of the crisis is behind it as a Swiss bank considers reviving shareholder payouts. We'll hear from the chief executive, Sergio Armotti. And Novartis trims its 2020 sales forecast on pandemic disruption. The group's chief executive tells us he's cautiously optimistic about a COVID vaccine. Well, good morning, everyone, and welcome to Bloomberg Surveillance. I'm Francine Lacqua here in London. Now, the markets are moving sideways a little bit, but they're still quite optimistic about things to come. This is what I'm looking at overall. A lot of the focus, of course, on the markets, if we can get the board up for you, is dollar weakening, but actually stocks advancing globally. Also, U.S. equity futures are up after these European leaders reached a deal on the landmark stimulus package. And if I look at equities rising also across Asia, Australia, for example, outperforming after the government boosted job subsidies. So after 4 days of tough talks, European leaders have agreed on a landmark stimulus package that will see the bloc issue 750 billion euros of joint debt. The emerging
I'm placing an order to sell short euro at a price 114.416. So order placed to sell short at 114.416.
And we are getting one today, even if, of course, as you
New position opened on euro at 114.416. Short position.
7 years. So overall, it's your typical European compromise where every country will tell you it's a good deal for their government, their taxpayers on the country, and it's overall a good thing for the European Union.
Thank you so much, Maria Tadeo, there in Brussels for us. Now, joining us this morning is Andrew Sheets, Chief Cross-Asset Strategist at Morgan Stanley. Andrew, great to have you on a pretty momentous day. When you look at the stock market performance, they seem to be okay with the deal. How long can it last?
Yeah, well, look, I think it is important to step back and appreciate that this is a very big deal. It's very significant. It's, I think, been surprisingly close to the initial proposal, and it's happened quite fast. I mean, even though I felt, our call at Morgan Stanley was quite optimistic around the deal getting done, we still thought there was a good chance it might take kind of a second session, to kind of finally wrap things up. So the fact that they did it in this round is good news. And I do think it's helpful to the European story, where European assets have lagged for a long time, where they're generally cheaper. And so I do think that we can see some sustainable outperformance from the euro, from European equities here over the coming months. I think the bigger concern is that, this is one of several positive things that's happening in July, along with earnings season, along with maybe another U.S. fiscal package. Once we're out of July, those positive events are behind us. And so I think I'm more concerned in that August-September period, what's going to be then the next catalyst to take kind of the broader market higher.
Yeah, and Andrew, you basically argue that over the next 2 months, the positive catalysts fade, there's seasonality getting worse, and near-term risks emerge. What does that all mean for stocks?
Yeah, so I think it means a tougher period for stock markets. So there's that old saying, which is a great saying, that it's better to travel than arrive, and I do worry a little bit that as you're into August, you've arrived with a number of these factors that we're having a pretty good earnings season now, but that will be behind us. We've had a very successful European summit, but that will be behind us. That we do think that the U.S. will pass another round of fiscal stimulus around the end of the month, but again, that will be behind us. And even I think some of the good news on vaccine development, which is certainly very encouraging. Again, the kind of the phase 1 data will be behind us, and it will be some time while the market has to wait for what are the results of the phase 3 trials, which we think we might not get until sometime in October. So it's that kind of gap in news at a time when we do think there's some rising risk that some of the economic data momentum softens a little bit, and that you're into a period where, at least for U.S. assets, kind of August is when you can often start to see some worsening kind of pre-election performance, that the market starts to care more about the U.S. election. It's harder for people to take on new investment ahead of the election, and I think a lot of investors just decide to wait until they know the result before making their next investment.
So what are your top picks, Andrew? Where do you find value from here? What kind of strategy should we be looking at, given that I guess some of the safer stocks are also look expensive?
Well, that's a great point. I think complicating this, I would love to say, that we're the only ones who are concerned about, a slowdown in growth. I think the market's very concerned about a slowdown in growth. I think you see that in where bond yields are. I think you see that in where volatility is. I think, exactly as you mentioned, I think you see that in how much a lot of these defensive stocks have outperformed. So it doesn't, I think, do.
Stop on profit for Canadian dollar at 1.35041.
Valuations in Europe are very reasonable. You don't election-related risks. I think also cash corporate bonds have a very positive dynamic behind them, in that you've had very heavy issuance of this debt from April through now, as companies have kind of rushed to grab financing while it was available. We think that now slows a lot, and so you'll just have far fewer bonds coming into the market, which could help some of that performance and some of that supply-demand imbalance in the corporate bond market.
Andrew, do you buy what central banks buy? Is that still a good strategy?
I think in credit it is, because I think there again you could have this kind of dual dynamic of the central banks are supporting the markets and providing a backstop to the market, and supply is then slowing down. But I think the tough thing there is, I think if we look at, say, the government bond side, central banks have already pushed real yields down to record low levels. That obviously, I think, reduces the risk reward. And I'm actually very curious, because I think it's actually very hard to tell where expectations are for the Fed meeting next week. And I think that we don't expect the Fed to announce any major new action at that meeting. That's our expectation, but I think investor expectations are actually quite varied about what they're expecting, and so to the extent that if they don't do anything, does that come across as actually a little bit of a disappointment is, I think, a kind of a big unknown.
Andrew, thanks so much. Andrew Sheets there from Morgan Stanley stays with us. Now, coming up, the tech trade comes roaring back. We'll talk big rally in the NASDAQ with Andrew Sheets. That's coming up next, and this is Bloomberg.
We closed position on Canadian dollar at 135.041, profit £200.
It is critically important that the markets stay open in this time, as opposed to trying to take breaks in the middle. I think that that'll just push off the situation a little bit, but actually could create other pent-up issues if you do close the markets.
Economics, finance, politics. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Still with us, Andrew Sheets from Morgan Stanley. Andrew, what do you do with all of the technology stocks right now? You look at NASDAQ, and it's on a tear.
Yeah, so look, I mean, we've been more cautious on the sector, and that obviously has been the market's been moving the other way. The sector's been very strong, but I think we're focused on kind of in the near term, a very specific issue, which is that we're into an earnings season. We're into an earnings season that's actually gone pretty well so far for the companies that have been reported. But a lot of the big tech names, they haven't reported yet. They're reporting later. And not only are they reporting, later in the earnings season, they often haven't had their expectations be cut nearly as much as a lot of the names that have reported so far. So I do think this is going to be a really important earnings season, generally, but especially for a lot of the kind of the very popular kind of secular growth and tech names where earnings expectations have not really come down, where I think the market is expecting them to be quite immune in some ways from everything that's going on, and that might be the case given their business models, but it might not be given kind of how far-reaching the implications of this virus have been. And so, our concern is just simply that maybe those estimates are somewhat too high, and that causes some relative disappointment as we go through the earnings season.
Andrew, is that for all tech or for the big tech, or would you do a difference between, the Asian tech, for example, and the U.S. tech versus the Europeans, although we don't have many European names at the moment?
Yeah, so I do think this is maybe a slight relative advantage for Europe, because I don't think you have the same issue of overly optimistic earnings expectations. The earnings in Europe have been slashed dramatically, which we think creates actually just kind of a very easy bar to clear for Europe. And I do think in the U.S. you could see quite large differentiation between the tech names, because I'm sure you will see some names that are able to work through this and show that they really are less cyclical. They really are immune. They're really benefiting from this new environment that we're in. I think our concern though is just there will be enough names whose business models will prove more cyclical. And I think it's interesting. Morgan Stanley's analysts did a large survey of CFOs, and a result of that survey was actually a pretty sizable indication that companies are planning to cut their technology investment, just given companies are forced to cut costs given everything that's going on. So again, that to us indicates that the sector might not have quite the kind of the halo, the kind of the non-cyclicality that is currently being expected of it.
But does that assume, Andrew, that once we have a vaccine or once this dies down, then we go back to working the way we used to?
Yeah, I think there is a little bit of that assumption, and I think that actually the longer term picture of the market. I'm glad you brought that up because I think that's really fascinating. You had some very positive vaccine news yesterday. We remain at Morgan Stanley quite constructive on the prospects that a vaccine ultimately will be successful, that we'll see one in wide circulation by the middle of the year. But you look at the bond markets and you look at the way some of the markets are pricing also growth versus value and some of these kind of secular growth names that have benefited from the current kind of abnormality. And the bond markets these names are really pricing a world that does not return to normal. You have very low bond yields, very flat yield curves out kind of as far as the eye can see. And so I actually find that the biggest kind of disconnect with some of the vaccine optimism is I think the more optimistic you get about a vaccine, I think the more optimistic you should be getting about the world returning to something that looks more normal. And it won't go back to exactly the way it was, but I think it could go back to being more normal than is kind of currently priced in.
Andrew, what do you do with the gold right now? I'm hearing very different takes. I mean, we have a nice bump up for silver, but gold kind of seems to be the one to watch.
Yeah, gold. So look, I think narratives matter, stories matter in the market, and I think gold has an excellent story behind it. That you have an environment where central banks are keeping policy very easy, where the dollar is set to weaken. That's our currency call at Morgan Stanley. Where there's a lot of uncertainty, all those things benefit gold. I think the challenge for gold is, especially now, is translating that into actually kind of a more quantifiable justification for the price, because I think you could argue that the gold strength that you've had is going kind of further and farther than what you can explain by what's happening with the dollar or what's been happening with yield. So I think the story is still good. I don't see that story changing in the near term, but I do think that what would change potentially that story is actually going back to the previous question. The better the news that comes out of the vaccine side, the better the indication that things go back to normal. That would actually start to maybe undercut a little bit of gold's narrative. So I don't think that changes in the next kind of month or two. But in terms of trying to express those themes, I would probably prefer to do it as simply being short the dollar itself rather than to try to do it via an instrument like gold.
Andrew, thanks so much. Andrew Sheets there, Chief Cross-Asset Strategist at Morgan Stanley. Now, coming up, is the worst over for UBS? Well, the bank has signaled a return to buybacks and dividends. We'll bring you our interview with Chief Executive Sergio Ermotti later in the show. This is Bloomberg.
I'm placing stop on profit for euro at 114.39.6. Okay, stop on profit at 114.39.6. That will give us, if it will reach this level, what? £200 in profit. All right.
European Union leaders have agreed on a landmark stimulus package. Joining us now from Brussels, Guntram Wolf, director at Bruegel. Guntram, great to speak to you today. Now, you think this is a positive deal. Could this have happened, more integration of Europe and what we've seen signed off on, if we hadn't had a pandemic?
No, I don't think so. I really think the pandemic was the trigger that allowed us to really move and move in a different game. I mean, this really is a different game. This deal, it for the first time really establishes a true insurance mechanism where countries receive grants from the European Union, and the European Union actually borrows money in the capital market. So borrowing for grants is something that wasn't foreseen in the EU, and now it exists. A precedent has been established, and it is paid out according to the size of the shock of the pandemic. So really the countries that are hit the hardest economically, they will receive the largest part of the pie. So in that sense, I think really it's a big deal, and it's normal that it takes 4 days to really come to that deal, given how new it is and how really game changing it is.
Guntram, you know, given this deal, what will Europe look like in 4 to 5 years? Is this just the first step towards real fiscal integration?
Well, look, I think it is definitely a step towards fiscal integration. I mean, there's no question about it. Now, everybody, of course, wants to emphasize, especially the northern countries, that this is a one-off. It's really done only because of the pandemic. And it is really a sort of just a one-off thing. But of course, it establishes the principle of long-term borrowing. I mean, the money will only be paid back by 2058, so really long-term borrowing. And the precedent has been set. So if there is a new pandemic or a new whatever crisis striking in 5 years or in 10 years down the road, this mechanism can be reactivated, and new borrowing can be done in the markets and, you know, be paid out to the member states. So in that sense, it really is some sort of a step towards a more federal Europe.
Guntram, what have we learned about alliances in the European Union over the last month or so? Traditionally, it was always the Franco-German alliance. Does it still hold? Can they still decide, or do they need to be more inclusive with the others, especially the Nordic countries?
Well, I would say in the end, they got their way, right? I mean, France and Germany made a big proposal, and to a large extent, that proposal still went through, and they really put the so-called frugal four into desperation. I mean, especially the Netherlands was really extremely worried always since the moment that the UK decided to leave the European Union, that they would be left alone and that Germany would go down and become almost French. And Angela Merkel really made a big turn and shifted her position. And so in a sense, it was a nightmare scenario for the frugal four. And I think that also explains why they were such difficult negotiating partners. But, I think in the end, they also saw that they can't block progress forever. And in the end, they agreed and, of course, got their rebates reinforced, which is sort of the price Germany essentially had to pay to them to get them agree on the deal.
Guntram, thank you so much for speaking to us today. Guntram Wolf, their director at Bruegel. Now, coming up, Sinargan soars after finding its drug cuts the risk of developing the worst COVID-19 symptoms. We'll speak to the chief executive about this next, and this is Bloomberg.
Another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television.
I was actually poor.
No foreplay?
Eat your bag of Lay's with a smile on your face.
If all the diseases have been taken, I'll take a tax.
Economics, finance, politics. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Let's get straight to the Bloomberg First Word News. Here's Laura Wright. Hi, Laura.
EU leaders have reached a landmark deal on 750 billion euros of stimulus. It will see the bloc issue joint debt to help member states tackle the economic downturn. The package includes 390 billion euros of grants and 360 billion of low-interest loans. The agreement comes after more than 4 days of negotiations and required unanimous approval. UK households are experiencing the biggest income shock since the 1970s oil crisis. That's the stark warning from the Resolution Foundation. It intensifies the pressure on Chancellor Rishi Sunak. Forecasters are warning of mass job cuts this year unless government help is extended beyond the current furlough plan. Novartis is trimming its sales forecast for the year. That's as the pandemic has hit demand for some of its medicines. Sales are now expected to grow by a mid-single-digit percentage, but in contrast, the range for the pharmaceutical company's earnings growth has been narrowed to the upside, likely expanding in the low double digits.
We have a broad internal research effort to find novel coronavirus medicines. But across these medicines, we're not looking at this as a profit driver. We've committed to really do this from more of a humanitarian standpoint.
Jeff Bezos added $13 billion to his net worth yesterday. That's the biggest single-day jump for any individual since the Bloomberg Billionaires Index was created back in 2012. Bezos' wealth is up more than $74 billion this year. That figure alone would make him the 7th richest person in the world. Global news, 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Francine.
Thank you so much, Laura. Now, shares of Sinargen, a tiny pharmaceutical firm born out of a UK university, have soared more than 500% in the past 2 days. That's after the company said its experimental drug cut the risk of developing the worst symptoms of COVID-19. Now, in a clinical trial, the probability of a patient needing ventilation or dying dropped 79% for those who got Sinargen's drug versus a placebo. Well, for more on the trials, we're delighted to be joined, and also for more on the next steps, by the Sinargen chief executive. He's Richard Marsden. Richard, first of all, there was a lot of buzz around your company, and congratulations on what we know so far. Do you think at this point the data is actually good enough for the treatment to be authorized in emergency rooms?
I can't answer that question until I've spoken to the agencies. So the data we put out yesterday was the result of having dosed people in hospital. So it was a 100-patient clinical trial with placebo against our drug, SNG-001. We've got very good data that we're really pleased with. We've got to complete analysis of that data, talk to the regulatory agencies, work out what additional data they need to consider approving a submission.
But how much more data do you think they require? I mean, so I'm not a virologist. A lot of people watching are not a virologist. I've been speaking to our Sam Fazeli, who knows and understands this maybe more than anyone that I know. Do you know if the trial, actually met its primary endpoint? Like, where are we? Give us a little bit of flavor of what you think happens next.
Well, we are pleased with the data, and it's that protective effect that you just described, but also at the other end of the scale, on the primary endpoint that we were assessing, this ordinal scale, which was proposed by WHO back in February and March as the endpoint to use. We also improved the chance that you can recover back to a level of no limitation of activities or better with this drug. So we couldn't have asked for more from this trial. And your question is a very good question, and I have to put that to the agencies. And until we've got that information, it'd be wrong for me to speculate.
Yeah. How quickly are you having these conversations with regulators and agencies, and how quickly will you get a response back from them?
Well, things are happening very quickly. The MHRA, who we've been engaged with thus far, the UK regulatory agency, have been fantastic to work with and very supportive of this clinical trial. We will talk to the EMA and the FDA, and they are processing things very quickly at the moment. But you know, I think we're talking a small number of weeks as opposed to the normal months turnaround for this sort of engagement we need to have next.
Richard, just so everybody understands it, so once you get approval, if you get approval, then the drug and the nebulizers used to deliver it need, of course, to be produced and manufactured in large quantities.
Yeah.
Give us an update. So if you do get approval, how quickly can the rest be done?
So time is the challenge here. What we are doing is technically something that you know, is a well-trodden path, and recognizing that time is the challenge, we started all this activity back in April at risk on the assumption that we would get good data. And our aim is to be able to provide hundreds of thousands of treatment courses, which would be millions of doses later this year. That's what we're aiming for.
Do you have enough manufacturing capability at the moment to do that? Or do you have to join with someone, go into partnership with someone else?
Yeah, we don't do it ourselves, so we contract the manufacturing out, and we've been working on that, you know, for the last 2 or 3 months to make sure that we can hit that target that I just talked about.
Okay, but does that have to be enlarged? Or at the moment, given the alliances that you have, you think you'll hit that target?
I think we will hit that target, yeah, that's what we're aiming for. And it's more a question of scaling up. It's about expanding as opposed to starting new steps.
We close position on euro at 114.396, profit £200.
There are various ways of distributing the drug, and we are talking to a company who will be able to distribute this drug. I think ultimately it may need the might of a large pharma company to expand the distribution in multiple markets and negotiate with multiple governments. Our focus today is to get on with everything that is going to make that possible. So that is completing the analysis of the data, talking to agencies, making sure all of the scale-up activity is being done so that we can produce, you know, a sufficient drug to meet demand later this year, assuming everything goes well.
Are you in talks with any big pharmas?
We've been talking to the large pharma companies because of this program generally. So we were in the middle of a trial in COPD, which is chronic bronchitis and emphysema, when the coronavirus you know, broke onto the scene in January. So we've got a good dialogue. It's my job to have a good dialogue with the large pharma companies, and they're very interested in what we're doing.
All of them, or is there one in particular that is more interested, that you see working with more in partnership in the future?
There's a cluster of them. They have to be big, they have to be global, and generally interested in respiratory or infection or biologics. And you know, but there are plenty of them.
Okay, Richard, thank you so much. We'll have to get you back on to have more of the details. Richard Marsden there, the Chief Executive Officer of Synargan. Now, coming up, is the worst over for banks? Is it over, the worst over for UBS? Well, the bank has signaled a return to buybacks and dividends. We'll bring you our interview with the Chief Executive Officer, Sergio Ermotti. That's coming up next, and this is Bloomberg. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg Business Flash. Here's Laura Wright. Hi, Laura.
Thanks, Francine. Billionaire Jack Ma is taking internet finance firm Ant Group public, and sources have told Bloomberg he's seeking a valuation north of $200 billion. Ant is already more richly valued than most Wall Street firms, and if conditions are favorable, we're told the company could look to raise more than Saudi Aramco's record haul of $29 billion. Bayer has failed to overturn the first jury verdict that its Roundup weed killer causes cancer, but it did get the $79 million award slashed by 3/4. That particular lawsuit isn't covered by Bayer's broader settlement, which resolves around 3/4 of US claims. Bayer's failure to get the verdict overturned may encourage some of the holdouts. Danske Bank may need to cut at least 1,000 jobs if it's to meet the latest cost-cutting goals. That's according to analysts monitoring the lender. The bank's chief executive told Bloomberg on Friday he's planning significant staff cuts. The lender isn't commenting beyond the guidance it gave last week. And that's your Bloomberg Business Flash. Francine.
Thank you so much, Laura. Now, the worst may be over for UBS. The bank has signaled it may restart share buybacks and dividends payments as soon as next quarter. That's after the wealth management division reported higher than expected net new money. Well, Bloomberg's Manoj Krani spoke to the chief executive, Sergio Armotti.
Our business scenario, the 70%, is de facto based on severe economic contractions in the next few quarters and with a recovery, although not to the same extent that we will see the slowdown in 2021 and then coming into 2022. The 30% is of severe recession, and this is really the one that we need to put in our models in order to have the prudence necessary.
Stop on profit for Japanese yen at 107.298. Stop on profit for Japanese yen. Sorry, 107.280. Yep. Okay, I'm placing a stop. It will give us about £200 profit if it will go back and reach this level. Yeah.
Next 12 months in any case. So I do think that the reality is that what we will experience after this crisis is that many companies will be able to make it and go through and be probably even stronger or be well positioned for the future. And the one that were already struggling before the crisis probably will have a hard time to recover. And this is where you will see probably still a second leg of the economic consequences of the crisis being played out.
With that scenario, are we underpricing, underassuming the level of defaults that will come globally?
Well, it remains to be seen, but it is fair to say that markets remains quite complacent, I would say. That there is not a lot of, if you look at equity markets, even credit, which were quite a good investment pick, as we spoke last time. Well, now they are, if you look at spreads have been coming and therefore there is not a lot of room for many negative surprises going forward.
JP Morgan says that as far as the credit markets are concerned, we are in a hallucinogenic moment. We're locked in a collective hallucination in credit markets. Does that chime for you in Europe and the US, Sergio?
Well, that's, it's not very surprising if you see across all asset classes, the amount of liquidity and money around is driving this kind of situation. So one has to really continue to look at a huge diversification and not avoiding concentration on any kind of asset class or underlying
you still think there's mileage in credit, though, even at this stage with the central bank backstop?
Where in some areas maybe there are opportunities to pick up, but as I said before, the name of the game is diversification and also taking a little bit maybe liquidity risk on certain kind of investments in return of higher long-term returns.
Well, that was the UBS Chief Executive, Sergio Ermotti, speaking to our very own Manus Crani. So we'll have plenty more, of course, on the banks. We'll look at dividends. This is what the markets are saying. Now, the markets are focusing, of course, on what's going on in Brussels, or at least the fact that the EU has clinched this massive stimulus deal that seems to be binding the continent together. Stocks are actually climbing on these stimulus measures, the dollar weakening, and then I don't do this very often, but I did want to have a look at what silver was doing, rising for a third session. Coming up, a man who knows about adding value. Francesco Trapani ran Bulgari for nearly 3 decades and orchestrated its multi-billion-dollar sale to LVMH. Since then, he's turned his hand to the world of shareholder activism. He joins us next. Don't miss it. This is Bloomberg.
Climate change is the defining issue of our time, so we've redefined how we cover it. With clear data and rigorous journalism, we rise to the scale of the challenge to reveal the breadth of possibility. We look at stories from every angle to provoke debate, spotlight solutions, and make sense of the greatest crisis of our generation. Bloomberg Green, solutions for a changing climate.
It is critically important that the markets stay open in this time, as opposed to trying to take breaks in the middle. I think that that'll just push off the situation a little bit, but actually could create other pent-up issues if you do close the markets.
Economics, finance, politics. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now, tech has long been the poster child for growth, but steady earning growth and an ability to make money in its stay-at-home world has made the biggest tech names synonymous with quality and utility too. As the industry's earnings get underway, Scarlet Fu goes in search of potential problems.
The biggest knock against big tech, their outsized gains leave little room for misses, and investors who've been piling in may be quick to flee, especially if vaccine optimism or an improving economy sparks a lasting rotation into other sectors. So here's what could remove some of the shine from the 5 biggest tech names. For Apple, the pandemic may delay the iPhone 12 and leave the company unwilling to give a sales forecast for this quarter. Amazon revenue likely grew more than 25%, but it's also spending a lot. How much will it spend to keep its delivery network running smoothly and on COVID-19 expenses? Microsoft is benefiting from a shift to the cloud, but is it giving up some revenue now by allowing deferred payments on some contracts? And if the economy stumbles further, advertising budgets could disappear, hurting Facebook and Alphabet. Alphabet tends to rely on small businesses, particularly in the hard-hit travel sector. When you've only gone up, it doesn't take a lot to knock you down a peg.
Well, that was Bloomberg's Scarlett Fu looking at tech surge as the industry earnings gets underway. Now let's talk about the world of shareholder activism in 2020. My next guest is the former chief executive of Italian luxury company Bulgari and now runs Bluebell Capital. Some of the fund's investments include Hugo Boss and Lufthansa. Retail and the travel sector have been hit hard this year amidst the pandemic. Well, joining us now is Francesco Trapani. He's former Bulgari chief executive and founder of Bluebell Active Equity Fund. Mr. Trapani, thank you for giving a bit of time to surveillance. When you look at what you're interested in, I know you've targeted some banks, Mediobanca, I know you've talked to some cinema. How does that pandemic change the industry groups where you see value and you know, a need for change?
Yeah, basically what I would say, just to get started, is that we are invested in luxury, to be honest. And for example, we have an important long position with Tiffany, and this because we think that the rationale behind the acquisition of LVMH is very strong for both partners. For LVMH is the best way to rapidly get the absolute leadership in jewelry worldwide after having purchased Bulgari a few years ago. And it's also true for Tiffany, because if you want to aggressively invest in your brand and operations to step up your growth, it's better to be owned by a stable big shareholder than instead being totally public in the US. So we are invested there, and we wait, and we're waiting for the closing of the operation that we think is going to come very soon, not more than in the next 4 to 6 weeks. We do have also other positions.
Yeah, are you seeing any signs of gradual luxury? Are you seeing any signs of gradual luxury recovery this year? Are things getting better, if slowly?
Well, after the first half, there has been a disaster. You have seen people have lost between 40 and 50% of the business. Things will improve, but there is no way that we're going to see, at least in our opinion, a V-shaped rebound. This for many different reasons. Well, the real economy is in a very tough situation. Tourism, that is so important for luxury, is super down. So we are going to see a slow recovery in our opinion. I mean, Vox Populi, I think we can say that we are going to see probably the numbers of 2019 only in a couple of years from now, not before 2022. So another important thing is that certain companies, luxury companies today, have a very high valuation. They have a value that is very similar to the one that they used to have before COVID, and this is totally unjustifiable because of all that. So to be honest, we do have some short position on certain luxury groups.
I mean, is the luxury group industry going to narrow? Are there too many luxury groups at the moment? And, you know, what do you make a difference between a winner and a luxury group that won't survive or that is a loser?
No, well, the luxury groups that we have in front of us today are all exceptional companies, very strong, and they will continue to be leaders. The real thing is that there are some independent brands, and here comes the question, because some of them are huge companies like Hermes or Chanel, and they are out of the questions. But there are many other companies that are much smaller, and these people are under pressure. So we may see, my opinion is that probably next year, not before next year, but probably during next year.
Position closed on Japanese yen at 107.280, profit £200.
People that have lived with PE in the range of 20-25 times for the last 5 years, now they are at 45-50, and this is, as I said, I mean, not understandable immediately, because this company will not, they are not on the verge of very aggressive growth, but they're going to have to wait for some time.
So does the movement to shopping online accelerate, or does it actually change? The pandemic showed that we can buy a lot of things online. What does that mean for the companies that you like and choose?
Well, of course, the e-commerce that was already playing an important role before is becoming extremely important, especially in certain countries. Having said that, if the focus is on luxury, we have to recognize that most of the brands were doing very little with digital before COVID, so they're going to go up and rapidly. But of course, this is not something that will become super important for luxury brands in the short term. Is gaining